Here's how you can cut your tax bill whilst investing for the future. So today we're going to talk about pension contributions and how in practice you can get tax relief on your pension contributions. Now this can often be quite confusing for a lot of our clients. There are multiple different pension plans that you may be under with your employee and different ways in which you can make pension contributions. And the way you get tax relief is kind of different for each method. So firstly I'm going to talk about the standard pension contributions that most individuals who are employed would make. I would say probably 90% of people are under what we call a salary sacrifice scheme. Now this is quite literally where your pension contributions are deducted from your gross pay, meaning that you are taxed on the amount after pension contributions. So just to demonstrate that very simply, let's say you earn £50,000 per year. That is your taxable salary as per your contract. As part of your agreement with your employer, you make contributions of £5,000 per year. That is quite literally deducted from your salary to leave you at a taxable figure of £45,000. The £45,000 is the income amount that you are taxed on and you would see on your P60. If you're under a salary sacrifice regime, there is no further action that you would need to take when filing your self-assessment. If you're using our software, there's nothing that you'd need to include around pension contributions to attain additional tax relief. That is salary sacrifice contributions. There are a couple of other methods and ways in which you can get tax relief on your pension contributions. As I said, most people are probably under a salary sacrifice regime. There are some employer pension contributions and plans that would not necessarily provide full tax relief at source. Very common for these plans to maybe provide 20% tax relief at source. However, if you are a 40% taxpayer, you would need to claim the additional relief on your self-assessment tax return. Here's how it would look. So using a figure of £75,000 of income, let's say you've made contributions in total of £10,000 per year. Now these are broadly deemed to have been made net, so out of your net pay. The contributions are actually made after you've paid tax. The way that this would work in terms of getting relief is by way of an extension to the basic rate band. So the basic rate band in the UK, the amount of which you paid 20% tax on, is the first £37,700 of your income. If you've made a net contribution to your pension scheme of £10,000, this is deemed to have been grossed up on the tax return, and you would actually get an extension to the basic rate band and an example of £10,000 contributions of £12,500. So that's quite literally added to your basic rate band, and now this basically means that you are taxed on the first £50,000 of your income at 20%. So now your basic rate band is £50,000, meaning that you pay 20% tax on the first £50,000. The way to demonstrate this and show that you're kind of getting the additional relief here is by taking this £12,500. This £12,500 has effectively already been taxed at source at 40%. The tax bill on the £12,500 is £5,000 initially. So what you're effectively doing is you're moving this £12,500 from the 40% band into the 20% band, and it's now taxed at 20%, which actually means that you're making a tax saving of £2,500. So that is what you would need to do if you're using our software to claim a relief on additional pension contributions that have not been deducted from your gross salary. You would need to enter the net amount of contributions. Our software would gross this up at the relevant rate. It would extend the basic rate band, and you are likely in a lot of cases to see a refund representing the fact that the income's been moved from the 40% bracket into the 20% bracket. So one more thing to mention about pension contributions is the interaction with the tax-free personal allowance. Now, if you're under the salary sacrifice regime that we spoke about at the start, the way that you would keep yourself maybe below the £100,000 so that you keep the personal allowance is by agreeing with your employer that you're going to make more pension contributions. So very quick example, if your base salary is £105,000, you can agree with your employer that you're going to make more contributions to get yourself back down below the £100,000. Very quick demonstration. Your base salary, as per your contract, is £105,000. You're potentially already making some pension contributions, but if you could pay another 5 or 10%, let's call it an extra £5,000 contributions, your P60 figure is going to be £100,000, meaning you're entitled to the full tax-free personal allowance of £12,500. Very common for our clients to quite simply just make more pension contributions under a salary sacrifice regime. But how does it work if you're not under a salary sacrifice regime? And that often causes a lot of confusion for some of our clients. Now, effectively, as we've kind of mentioned, you would still be taxed if you're not under a salary sacrifice regime. You would still, in theory, be taxed on the £105,000. So on your P60 and on your tax return, you're taxed still on the 105. HMRC, behind the scenes, has a concept called adjusted net income. And the adjusted net income is not kind of what you're taxed on, but adjusted net income is relevant for other things, such as personal allowance. So what you can do is make additional contributions to bring your adjusted net income back down to £100,000. This is not to be confused with the taxable income. If you're not under a salary sacrifice regime, the way that the relief will work by way of extension to the basic rate band, but you can still retain your personal allowance, and this is quite important. So this is your taxable income, £105,000. If you wanted to retain your personal allowance, you can make the contributions out of your pocket after tax has been deducted of £5,000, meaning that your adjusted net income again becomes £100,000. You do still get the tax-free personal allowance. You don't see this figure on your tax return, £100,000. You would still see this figure and you would see your basic rate band extended, but you would see on our calculation that your personal allowance is £12,570. So can be quite fiddly, can be quite confusing to work out how these kind of different pension schemes are working. I guess very quick summary, there's 3 different things that we're seeing. Salary sacrifice contributions are the most common and the most simplest way to retain kind of full relief at source. You don't have to do any work on the tax return after. The other 2 methods are more fiddly. We have built our software to handle these things, but you kind of just need to understand what type of relief you may or may not have had on your pension contributions. So the other 2 methods really are an employer pension scheme still that is not providing a salary sacrifice option. So not to be confused with a relief at source pension. You often kind of see a relief at source pension. A relief at source pension or net pay arrangement is the other one, are typically providing 20% tax relief, but not the full 40% tax relief. So if you're under a net pay arrangement or if you're under a relief at source arrangement, you would need to use the self-assessment to claim additional tax relief. And it's effectively exactly the same for any additional personal pension contributions that you make. So if you make pension contributions outside of an employer scheme, you make them out of your own pocket, you have a self-invested personal pension plan or a SIP, you would still get the tax relief by way of an extension to your basic rate band. And where relevant, your adjusted net income would be considered to potentially give you back the full tax-free personal allowance. So hopefully that's been useful. Our software is free to try. We encourage people to create an account, log in to the software, play around with their pension contributions and put this information in and see how you might be impacted and if you can claim additional tax relief.